Welcome to the Payments Geek Roundtable. We kind of wear the Payments Geek t-shirt proudly here at Modo, and thrilled to have Scott Harkey from Levvel joining us. And one of the things that we've been hearing out in the market a bit recently is, well, how can I think about payments in this sort of post-COVID, post-corona, post-every other thing crisis world? And what kind of changes are we going to expect in the future, or what are we seeing that's kind of different now? And so thrilled to have Scott Harkey here from Levvel talking about things you can do right now that are going to help you as we all respond to the crisis. Very briefly, my name is Bruce Parker. I'm the founder and CEO of Modo, and we're a bank-grade payment stack in the cloud. We focus on payments orchestration. That's probably enough of the commercial. That'll be it from us. Been in the payment space for a long time. And we've got with us Scott Harkey, as I mentioned, from Levvel. He's the Chief Strategy Officer and, more importantly, to me anyways, Head of Payments at Levvel, a really fast-growing, extraordinary technology and consulting and services shop based in the East Coast, based in Charlotte, North Carolina. Scott, if you don't mind, just give us a little bit of your background. Please don't leave out the recording stuff, the music stuff, and then also Levvel, if you don't mind.
Absolutely. Thanks, Bruce. Thanks for having me today. I must say this is the most informal webinar I've been on, which is awesome because not only can I wear a hat, but also it feels much more casual and just like a chat among friends. So should be good.
And it is.
So Scott Harkey, like you said, I'm the run strategy and payments at Levvel. So I'm by background the next bank guy. Spent 10 years at Wells Fargo and then another 5 at Bank of America, working on payments technology implementation efforts and a bunch of digital wallet work and other things. So come from that side of the world. At Levvel, I've spent the last 5 years building out a financial services vertical within the company, and work a lot with clients, whether it's banks or it's merchants or it's third-party tech companies or others, on figuring out how best to integrate different modern payment technologies or tools or products, and then really how to kind of roadmap that out over time. So it's not always just about the tactical, we need this now, but more about how do we position for the future, et cetera. So Levvel as a company, I'll give my quick 20-second pitch is, technology services. We do business and technology consulting, often starting on the strategic part of the why, the how, the with who, and then ultimately carrying that into designing what it looks like and then building whatever it is that needs to be built. So the heart and soul of the company is in building technology for companies, but we do offer advisement on the front end of that to help figure out what you should be building in the first place before you go and just start building things. So that's what we do, which is great for this conversation because it gives me a pretty good lens on a lot of the challenges that we see our clients facing, a lot of the decisions they're trying to make right now, and frankly, a lot of what's made some companies be able to weather things right now and even be positioned for growth and other things relative to others that maybe aren't as well positioned. So happy to talk about some of that today.
Well, that was a wonderful lead-in. It's almost like you knew what the next slide was going to say. Almost. I don't know. I want to accuse you of that, or whether there's some mind reading going on, or you just saw the slides before. But that's kind of the key question we want to talk about today. Okay, what next? All right, this stuff all happened to us. Here we are. We're all on Zoom. I'm learning about webinars on Zoom, real time with you all. And I got to tell you, just so you know, I have a bias. I have a bent. I have a way of filtering and interpreting the data about what's going on in this world right now. And it's kind of more of an optimistic bent. I think things are going to go up and to the right next. I think we will rebound. I think we will recover. V-shape, W-shape, U-shape. I don't know about the shape. I have no idea. I'm not an economist, but I believe in the power of capitalism. I believe in the power of the markets. I believe in the power of people who've gotten knocked down, finding a way to get back up. So I think for us, obviously, it's been tough here at Modo. But maybe, Scott, if you don't mind just giving us a little bit of how things have changed for you in the start of this crisis, or maybe where you guys are now. We were actually a little bit before we started about some of the the PPP stuff and all that. But what is the crisis meant for Levvel at this point?
Yeah, we feel pretty fortunate that we've been in a pretty good spot. I mean, we did have some client work drop out at the beginning of the year. We had some major projects with airline, and you can imagine how that went. Had some bank work that disappeared all of a sudden. So we're not immune to the market, but all things considered, we've been in a pretty good spot. A large part of that, in my opinion, we'll see how this plays out. And I don't want to, curse ourselves by making a statement like that. And then, we work at the pleasure of our clients, so that can change at any time. But we feel pretty good about our path this year. And a lot of that's because the things we're building are really, I mean, they're almost purpose built for weathering something like this, or even positioning for something like this. And a big focus of our company is on building technology to help companies essentially transform their organizations to be more digital, to be more nimble, to use modern tools. And if there's ever been a time when that need is emphasized, it's this sort of time right now, right? Where you can really start to see that if you had done some of that work, the advantages that it's giving you. If you haven't, you can see how it's easy, how obvious it is that it would help you if you had. And so, I think the thing that's still a variable is in just budgets and discretionary spending. And certainly, some companies and some industries are more susceptible to that, have to be more cautious, et cetera. So I definitely expect that to continue to have an impact. But by and large, it's a good time to be helping companies use technology to transform their organizations, because that's what they all need to be doing. And the ones that have are even in a better position. So again, I feel fortunate that we're in a pretty decent spot. And so far we're getting along okay.
I think what you're saying is you're describing the need for digital transformation as having a clear set of motivators right now. I think this picture may tell the story you were just saying. I'm not sure, but it's interesting to me that as we start looking at, okay, what next? There are a lot of things that we've had kind of jump to the front of the line. I know in some of the client conversations that we've had, long-standing digital transformation, which I think is kind of the buzzword, particularly in larger companies, around change and managing change and dealing with change, justifying change, putting up with change, whatever, just change, really has gotten a tremendous amount of impetus. And this notion of becoming adaptable, or needing simply to adapt to survive, has got a lot of emphasis, a lot of underlines, a lot of exclamation points. I think you're really well positioned probably to tell us a couple of examples. I mean, you have some examples of, let's start with good stories, people who've done a really good job of dodging that big swinging ball. And then maybe no names, but maybe some things where it's like, ooh, I'm not sure they knew what was coming. Can you give us a couple stories, a couple of news from the front kind of?
Yeah, absolutely. I think one overarching comment I'd make first, though, is any sort of change allows room to disrupt the status quo, right? And I think as humans, we get into rhythms and we do things a certain way, and it's really hard to break from that momentum of doing things the same way all the time. And digital transformation is one of those things, it's a broad, generic, overused term, but really it requires organizations breaking from that mentality of like, this is how we do things, that permeates so much through, especially the larger the organization, the more it permeates. And sometimes you got to just throw a bomb in something and blow it up and like start all over again. Right. And, this is an extreme, way of doing it, but like, I think what you're seeing is a little bit of that, of, if you can't do things the way you always did, because you just can't, then you have to figure out new pathways of doing things. And that applies both at a human level of us and our daily lives. And I don't drive to work every day anymore, so that's completely changed my routine. Like, I mean, you can embody it on a human level or an individual level, but then you also think about it in organization and just how things work and the common pathways and just all the noise that typically exists in that. When you have to go from, getting the SBA guidelines for the PPP loans at 10 o'clock at night one night and being ready to go the next morning, You can't go through a 9-month release cycle, right? You've got to figure out how to do that in 8 hours with whoever you can get like in front of a computer. That builds completely different pathways of how to operate. So I'll use that just as the overarching theme. I think in terms of specific examples, you can really start to look at different parts of, and especially in the context of payments, of the kind of payment value chain or the payment interaction with the customer. And one of the strongest ones to me, or the most obvious ones to me, has been in the context of restaurants and their shift to needing to do curbside pickup, delivery, et cetera. And that you can see a really clear difference between restaurants that had already invested in some sort of digital engagement with customers, whether it was doing actual ordering, whether it was delivery, whether it was a mobile app maybe. But you can see how companies or restaurants that had already positioned for that, it was really easy for them to transition to, okay, well, now everything is that, right? We used to get 20% of our orders through mobile. That was already an area that was accelerating and a lot of money was being invested in it. But now we get 100% of our orders from mobile.
Right.
If you've never had a mobile app, if you never had online ordering, that's a pretty big leap to make really fast, especially when you don't have people around to do it, right? Because all your employees are at home, and in terms of the IT staff or whatever, maybe you don't have an IT staff. You have to go suddenly find a vendor to give it to you, and vendor selection is the whole thing that gets hard when you can't meet with people. So what you see, an example like that, is companies really taking advantage of, hey, we already invested in some of these components of digital. We are much more ready to adapt to whatever comes our way. We work with a startup called Clusive that builds mobile ordering specifically targeted at coffee shops. And, they've been getting traction for the last couple of years, and you've seen the increase in it. But whenever all the lockdowns went in place, their volume completely exploded. And it's coffee shops that traditionally, only dealt with customers coming in the store. Suddenly that wasn't an option, and they needed an answer. And part of why this particular company was successful, or has been successful, is because the way they had built the product was it didn't require any new hardware. It didn't require the merchant to go out and negotiate some new contract. It was built into Square, and it was literally like a flip of the switch in Square to turn it on. And when you think of how, if you're a startup and you're building a solution, or you're an incumbent large company building solutions, it's not the things of ultimately that you need to plan for. It's the things that you don't see coming. And what ultimately allows you to be ready for those is building flexibility, adaptability, et cetera, into the product. And we believe technology is a large driver of that, right? So if I can turn on mobile ordering, or I can create that opportunity without having to physically put something in place or some large onboarding process, that's infinitely more valuable than something where I've got a big complicated onboarding process, as an example. I can give you a counter example if
please.
All right. So I think a good counter example is in the we'll call it the telecommunications space, right? And so I wanted to upgrade my internet because I'm doing all these wonderful video calls now, and I've never cared much about my internet speed, but decided it was time to upgrade it to make sure I had the best possible connection. So I call my provider. I ask for increased speed. I want to go from 200 megabits to 400 megabits, right? Cool. I figured they've got some throttle. They just flip the switch and they set me at 400. Nope. They have to physically mail me new hardware. They don't know how to tell me to install that hardware because they're used to sending a tech with it as part of just the natural order of things. They have to schedule a tech appointment, but then tell me the tech won't actually show up, but you'll see an appointment. And then basically, here's some instructions. Go ahead and try to set it up. And when it doesn't work, then you need to call us, right? And I'm a fairly tech, knowledgeable guy. So I can normally set up a router or modem. I set it up.
Okay.
Turns out they screwed up. They didn't have the right, basically they didn't have the right IP address on it, that they didn't register the right IP address. So I had to contact them. I sat on hold on the phone for an hour and a half. And then finally got to someone who keyed in the right stuff into their system, and then it worked. So again, there's so many ways that could work better and different and be instant, right? But because the model was built around an expectation of, we have a tech is part of this process. The tech just takes the hardware with them. The tech sets it up. They hadn't really invested in what would a fully self-service digital onboarding and delivery process look like, right? And so it was a huge pain as a customer, and I'm sure it was expensive for them in just all the components of that they ended up having to put in place.
Yeah, those are both great examples. The coffee shop that could flip the switch and something happens in the cloud, and then the more established organization in the broad telecommunications space. We won't remind people what exactly service area you're in to protect the guilty, who just assumed, hey, there's going to be a human who can handle whatever comes up. So we don't necessarily have to connect all the dots digitally. One of the things we see thematically, and have been hearing over and over again, is whereas cloud more broadly for payments infrastructure was interesting and people were talking about it. And in general, they recognize that's probably a cheaper place to operate. But it's a little bit more ethereal or academic. Now, all of a sudden, it's like, well, I can't service this stuff because I'm not supposed to send people into that building, or they're not supposed to be congregating here, there, or anywhere. And it's really, really hard to do some functions exactly in the same way that you're talking about. It could be really simple. It could be something as simple as your example of, hey, look, I just registered this thing with the wrong gateway. I got the wrong IP address. I got the wrong domain name server. Something really simple from a networking perspective. It's really, really hard if the first step was, oh, okay, go over there and push a button on something in a physical way. But then when we say, no, it has to be in the cloud, has to be accessible from anywhere, has to be secure, it has to be authenticated, but it has to be reachable, right? And now all of a sudden, that's a completely different deal. And so we're seeing some very large organizations that, for the same reasons, were happy with a data center-based solution where some of their folks could kind of surround that and do things, to now it really probably does need to be in the cloud. Whether or not it's this crisis or the next one, it sort of made the case, I think, in a completely different world. I think it's fantastic. It's as much the motivations and the reasons for doing things as it is the actual thing in and of itself. So the second thing that kind of is coming up over and over and over again, besides just the notion of adaptability, is, hey, wait a second, revenues are off. Revenues are off a lot in so many industries, so many different places. And there are a lot of different channels that companies might think about, exactly like, hey, that coffee shop might be less costly to deliver. It might be less costly for an order ahead model. Might be less costly for the communications company to figure out how to deliver more remotely and not involve a human being. And oh, by the way, if revenues are down, if we can make particularly variable costs lower as well, then that'll help. So I'm wondering, Scott, in terms of the new, it's never gone away, but maybe it's a renewed focus on overall costs, particularly variable costs, things you have to do every time in order to be able to deliver the good or service that you sell in your organization, and the channels by which we deliver that, digital versus physical. How are you hearing about things going on out there in the community? Focus now zeroed in on less the adaptability, less just how do we stay in business, and more how do we do so efficiently?
Yeah, I think this is a tricky one. Obviously the most attention from a cost reduction standpoint has been on, frankly, on furloughs and letting people go, which is the unfortunate side of things. But I think there's a lot of optimization that can also be done in the back office or in the stack, if you will. A couple of things. You already mentioned cloud. I think that is one for sure that if you just look at from a managing capacity standpoint, companies that have cloud infrastructure, other, elastic, basically scalability, where they can pay less when they use less, basically, right? I think are certainly seeing the advantage of that approach right now. I think when you look at how you repurpose existing investments, so again, I'll stick with the restaurants for a second and use the example of there's a restaurant chain, kind of local, called Show Mars, that traditional, go sit down dining restaurant. They have some to go places in malls and stuff, but they started selling deliverable, basically care kits is what they were calling them. And they were taking their supplies that they get as a restaurant. So a combination of things like a 6-pack of chicken, plus some spices and whatever, along with like rolls of toilet paper and cleaning products, and basically set up an online marketplace to sell those items. And it makes, in any other world, like, or any other time, it makes no sense. Like, why would you go to the Showmars website that you typically order a sandwich from and get, water and toilet paper and a 6-pack of chicken? But in times like now, it's suddenly like, well, actually, that's really clever, right? Because they've already likely bought a lot of this stuff from their suppliers. They're trying to keep their supply chains fresh so that they don't lose contracts and they don't essentially, handicap themselves for down the road, but they're repurposing it in a way that allows them to extract revenue out of it still. So I think, that's one of the more interesting things to me when you think about costs. Like, again, cost includes waste, right? And what we've seen a lot of is, again, especially in restaurants, but even some other industries as well, is contracts for a lot of things aren't like real-time contracts, right? They aren't 5-day or 10-day or 30-day contracts. They're for longer periods of time. So as a business, if you've committed to consuming something, whether it's physical things like in a restaurant that are perishable, or it's services from a vendor, or it's capacity for something, thinking of ways you can reuse that, and being creative about, is there a way to reuse that pre-purchase capacity product, whatever, to essentially either generate revenue or and somehow stem the losses, if you will, right? Obviously, when you can get out of contracts and other things, switching to more short-term contracts is an obvious measure of cost reduction. But I think also just looking at platforms, like I said, how you can reuse them differently. I think looking at tools that you've already bought and or integrated into, and saying, how can we use it more? Right. So maybe you've bought a product from a vendor that does, 10 things and you're using it for 2. And you can negotiate with that vendor, like, hey, like, if I were to use it for these other 5, right, is there some price break on that I could get, or something to effectively negotiate that, but leveraging what's already in place and somehow, increasing the usage of it. So I think of things like that as, there's some element of time boxing this, right? Of, obviously, if the time horizon is longer, there's a lot more you can do. You can invest more heavily in cloud. You can invest in more modern technology tools that allow you to operate at a lower cost and to make changes at lower cost. But I think in the immediate response of like, what can I do right now? You have to get kind of creative about leveraging things you've already invested in to some degree and getting more use out of them.
It's interesting that you mentioned both of those, because we have examples of that actually in our clients. We have one client who's an airline, and obviously, revenues, activities, bookings, everything are way, way, way down. And so the exact outcome was, hey, wait a second, how can we take what we've done? We've helped them out with some loyalty services and how to deploy their loyalty program throughout their environment more broadly. And now they're saying, okay, I want to make it portable. I want to go engage with strategic partners. I want to have our loyalty showing up in other ecosystems that are not about flights. And I think this is a perfect example, is because they literally said, well, we have the platform, we've implemented it, it's all hooked up and ready to go. Let's just start exporting it, precisely to your point. But on a longer time frame, it is interesting that, yes, the press for the cloud, that has some obvious cost saves, but those are longer running. There's a newfound interest in, I think, 2 things. One, bank transfers. And I think if real-time payments, or RTP, as we would say here in the U.S., they call it other things other places. So it's not always called that in every other geography. But the notion of real-time payments, I think, in the U.S. actually similarly had this notion of, well, I don't know, is the current ACH system good enough, especially if it's settled the same day? What are the use cases around? And I think what we're going to see is 2 things. One, yeah, we need to kind of press forward because we need to adapt to an environment that could change again, right? Like, as much as we don't want something like this to happen again, I think it's now embedded in people's consciousness. It's possible for everything to change very radically, very quickly. Hopefully not ever due to this exact virus again. But the other interesting thing is, and this is a little bit more sort of straight up the middle is, besides just implementing a brand new payment method like bank transfers or ACH or real-time payments, as those are now rolling out and are much more broadly available this year than they were last, and that'll just continue. We're also seeing, okay, let's just put two different processors, two different traditional payments companies kind of in heads-up mode. There's a famous, very, very large, maybe largest retailer who has sort of shown the way to a lot of people who've been doing this for decades now, of just balancing between folks who help them with payments and moving volume back and forth in order to get the best kind of contract. And to your point, the contract over a long period of time is relatively stable, relatively fixed. But I think we may see performance elements of that in payments specifically showing up more and more often. One of our clients, who's incredibly large, Fortune 50 type organization, is looking at tens and tens and tens of millions of dollars of savings just due to that, just due to lowering cost of payments acceptance, not by changing anything, not by sort of implementing anything brand new, although that may come later. But in this environment, precisely your opening comment, that's way more attractive than thinking in terms of staff or thinking in terms of the folks that you have engaged in your business or in the supply chain of your business. Finding ways to just do the same thing at a lower cost and being creative about it, precisely your examples, is really appealing.
Yeah, right. I'll give you one more quick example, Bruce, just because you mentioned both RTP and banks. And so we've got a client that implemented RTP and real-time payments, and then we're looking for use cases for it beyond kind of the obvious. And one of the ones they found was internal bank transfers, just from like internal bank customer to internal bank customer. The business case they wrote for leveraging a real-time payment system that they had already built and implemented for doing those internal bank transfers, it saved them $10 million a year in internal costs. Wow. Just in doing internal bank-to-bank transfers. So yeah, absolutely. Right. I think when you start looking around at how you can leverage some of the things that maybe you're already building or adopting or using, I think you have to look beyond the obvious and say, like, how can we use these things to tune the organization to extract, whether it's revenue or cost savings or whatever? Because like you said, I think, we don't want to see a bunch of people losing jobs, especially if there are other ways to recoup or to save money, basically, right? It's one thing to be in a tough position, but if you can leverage the technology to extract those savings and avoid having to do layoffs or other things to keep the company in a healthy position, then obviously that's better for all of us.
So fight the pandemic, keep people employed, buy frozen chicken from your favorite restaurant, and use real-time payments for internal transfers. I think, did I net it out?
Modernize your tech. That's it. Totally.
Modernize. All right. The last step, you made it. There were just three. We're on the third of three. So you're rounding the bend. You kind of past the middle. This is the part where we can just really get excited and finish really strong. So the last step, you're preparing your payments post-corona. That's kind of a mouthful. Is figuring out different ways to reach the consumer or the customer. And we touched on this a little bit. And I think it was not only how do we engage with customers or consumers in that buying cycle or that delivery cycle, but I think it's also probably how we actually conduct commerce, like that payment component and the engagement and delivery component. I think you had an example of both with the coffee shop and the communications example. So we've seen some movement that's interesting with grocery stores. We've seen some with CPG brands trying to figure out, okay, what does a direct-to-consumer model look like, which is completely different than what we have seen in the past. Scott, I'll pitch it over to you and just see where you're seeing the advent of more digital, different kinds of physical, or other ways in which people are engaging with customers in a new way based on the crisis.
Yeah, absolutely. So like you said, we touched on some of it a little bit, but I think there are a couple of interesting pieces of this. One is in, the poll question you just asked around the cost of payments, and the response to that is a great lead into one dimension of this that probably is not obvious on the surface to a lot of people, is the increased cost of accepting payments and the way that a lot of companies are having to do it right now, right? And if you look at the cost of a in-person transaction or a card-present transaction compared to the cost of a digital transaction, especially when you stood up digital kind of really quickly, can be quite a big difference and make it quite expensive, right? And so what we've seen is the merchants and others that had previously kind of positioned for this, either because they already offered the service or they negotiated their contracts in a way with their processors or their acquirers that allowed, some pricing that incorporated both, are in a much, much better position when it comes to cost of acceptance relative to merchants that are businesses that just got into digital because they had to. And so it's just a good way of reminding people that, one, you do what you have to do to survive. So obviously, if you're a business and your physical location is not able to accept customers anymore, you have to do digital to survive. But it also shows how a little forethought into different types of payments, negotiating with your vendors, your processors, your acquirers to account for that ahead of time. Looking at channels and channel partners that can enable you to basically support multiple channels. And again, looking at that from a pricing standpoint of what are you going to be paying for that from an acceptance standpoint. I think all those things are being highlighted right now of the more sophisticated companies that have done a lot of that. It doesn't matter what channel they're getting the revenue in. It's all good. I think another good example of this to move away from the pure kind of interchange aspect of it is to look at things like all the news and headlines around Grubhub and others, how those have become so critical for businesses, but yet how much the businesses hate them because of the amount of revenue that they take away from them, right? And it just shows, again, where, you do what you have to do to survive, but how there's not necessarily a level playing field in every channel, or every channel is not equal, right? And you have to weigh kind of the pros and cons of using these different channels against other drivers. And if you're positioning yourself better to either partner the right way or control the right aspects of your own destiny, then you can avoid some of these almost, prisoner scenarios where it's like, hey, we have to use Grubhub or whatever. And I'm just picking on them as an example because they were in the headlines. But we have to use these mobile ordering services because that's the only way we get customers. But at the same time, like we literally make no margin on what we sell because we're giving so much of it away. It reminded me of the refrain around the rates that Apple and Google for a certain period of time would charge on in-app transactions, right? Where they were taking the standard of 30%. And the breaking from that, there was a recent headline around, I believe it was Amazon that got enabled in an Apple Prime experience. So you can buy Amazon video content or music content through Apple, and Apple's it's come out, but presumably not charging them that same rate, which has allowed them to enable this feature. I think we'll continue to see that adapt. We'll continue to see channels both be monetized by the controller of the channels, but also the desire and the need for flexibility in that through partnerships and through other things. And I think especially in the merchant space, now we'll see an increased focus on larger merchants, chains, et cetera, finding ways to better leverage a multi-channel approach, but also maintain some control over the cost aspect of that, where they're pre-negotiating deals or contracts to account for that.
I think if I can play this back for you, and I'm going to put words in your mouth, so definitely, spit them back at me if it doesn't work, right? If it tastes funny. I think what you're saying is something along the lines of, and we've kind of been covering this as we've gone along. Digital channels were a little bit, not a plaything. They weren't a toy, but they were exclusively for a lot of organizations a means for growth. It was additional businesses, incremental business. And the restaurant examples you've used a couple of times in Grubhub, who you've kind of spotlighted. They really, I think their entire proposition to a restaurant that's already in place was, hey, and by the way, you could sell more. We've seen this actually in an industrial company who we have as a client. They sell very, very large pieces of equipment, very large pieces of equipment that are used in sort of industrial context. And so they kind of came to us precisely because this sequence of events happened for them in a way they didn't expect. They were selling parts, they were selling services, they were selling warranty, they were selling some monitoring capabilities and content like manuals and things like that online. And it went from, oh yeah, sure, it's a few $100 million a year, cool, let's just wire it all together, good. Let each of the business units on a global basis kind of solve for their business, solve for their region, et cetera. And then you kind of take a big step back and realize, okay, the costs associated with payment, the costs associated with delivery, theoretically, digital could be your lowest cost channel. And not only was it not, but because of some of the banking aspects of it and because they're a global company, foreign exchange, which shouldn't be this, was their single largest cost. That's bad, right? And so now that this entire set of digitally based delivery mechanisms and order management, e-commerce, all the regular things, but for a very large industrial company, have grown into the billions. Well, of course they wouldn't accept that, right? Like, I mean, of course they're consolidating global currencies on a daily basis and are very sophisticated about it. And they're awesome, right? They know what they're doing. But because they allowed this particular channel to sort of exclusively define itself in terms of, oh, it's just an incremental sale. It doesn't matter. All the margins are good, right? All the margins are good. It doesn't matter relatively if they're dilutive or accretive. It's just an incremental sale, right? I think what's happening here, and we've been talking about this in a couple of phases, is, oh, no, that is the sale. That's now really, really important, and we should treat it just like every other sale, and we should think about it end to end, kind of like your router showing up. That experience needs to be thought through, not just from a great delight for Scott as he sits at home and tries to increase the speed. I do want to point out to the audience that he switched his location. He is at home. I know he's at home, but it looks like he's in a different part of his beautiful office, and he's not. It's all a sham. It's all intended to make us believe something. I don't know what. But I think on this whole point, right, you're kind of saying, I think, and I'm putting these words still in your mouth, a lot of them, so many words. We have to think about these channels as if they're all important. We have to think about these channels as if they all have to be, I don't like the word omni-channel, but they all have to know how to play with one another nicely. And they all have to have reasonable costs. We can't ignore the cost model in one channel just because it's newer or cooler or digitaler or whatever. Is that fair, or is there any part of that?
Yeah, absolutely. Yeah, I mean, I want to pick on you because you're telling me I wasn't being articulate, and normally I get to pick on you about that. So I want to do that.
Say that. I did not use those words.
I just wanted a chance to throw a jab at you.
Nice.
No, but I think that's totally it. I think that's totally it. I think I like the way you positioned it as, digital for a lot of companies has historically been kind of like an add-on, right? And now it's a requirement, and to me it's probably less that digital is the thing that now is like it's got to be factored in, and you got to look at it holistically. Is like it could be any channel at any given time. You don't know, right? And you can't optimize for one in a way that disadvantages the others, because what things like this show is that you don't always have control over where it goes. Right. And so you're better off like accounting for the multi-channel, omni-channel, all the channels approach in a way that you think about whether it's your infrastructure or your contracts or your approach to account for all of them and to allow you to adjust like based on where the demand is, right? I think banking is another great example of this same point of, who would have thought that there's been all this dialogue for years about bank branches and like, are they declining? Are they increasing? Some banks are shutting them down. Some banks are opening new ones. Do they just look different? Like
some of them have couches. Some of them have couches.
Yeah, some of them have coffee shops. Like, but it's all right now. It's all completely irrelevant, right? Because they're all shut down. So it doesn't matter. And I just think how quickly that switch was flipped just highlights the, like, if you were stuck in debating, like, is branch a thing or is digital a thing? Like, you are so far behind the conversation. What you really need to be talking about is like, how do we actually create a good experience for the customer, regardless of where they are? And again, a lot of banks were. I'm not saying they weren't, but it shows you how abruptly things can change. And again, the banks that invested more in those digital experiences, not just in a good mobile app, well, of course that's great, but in really thinking about like, how do we cross sell to a customer if they're not coming in and talking to us, right? It's not just throwing ads at them. That's not going to work. All of the aspects of like engaging with a customer, those are the ones that are doing okay right now. Ones that hadn't, like they're struggling, right? And I think that's why you see a lot of smaller banks and credit unions actually in a better position, because they've done a lot of work in building those relationships in a way that they can still rely on them. I think a lot of the bigger banks haven't figured out how to connect with customers in a way that they can connect with them across channels. They've built these very channel specific strategies to engagement that just break down when you suddenly have to shift a lot of behavior over to a different channel.
Thank you for not using the word omnichannel. I appreciate that. I don't like that word. Hey, so we've got actually on this same topic, we got a question from the anonymous audience. So we have no idea who asked this question, which is how it should be. It's asking, can we talk a little bit about, I think this is as much Scott, you as me. Can you talk a little bit about what you're seeing in regards to IT spending by banks on core payments infrastructure, and whether or not banks have begun to realize their need or recognize their need for real-time payments based on COVID. So in the banking community, our favorite, everybody loves banks, especially on this panel. Banks are clients, banks are very important to us, so we'll be very kind in our descriptions. What are you seeing on core payments infrastructure investment fronts or topics?
Absolutely. I mean, we saw some of that prior to going into, earlier this year and late last year, just an increased focus on core payment infrastructure, a lot of relooking at not just bank cores, but the surrounding, whether it's payment hubs or it's gateways or it's API components of, standardized access into those. We see that going further and further kind of down the stack, if you will, in terms of bank size. So more and more regional banks and smaller banks, even credit unions, starting to look into the space and investing in the space. So I absolutely, I think a lot of it's driven, again, even pre-COVID, is driven by kind of recognition of the need for the increasing the pace of change. And a big part of we think about this space is specifically in that, right? And that, you don't want to be trying to figure out how to adapt when you have to adapt. You want to be figuring that out like before you need to do it, right? And so I think there are quite a few banks, and I think some of it is a lot of new leaders in place at banks that are more technology driven. I think there's been a much bigger seeding of non-bank people into technology teams at banks, into leadership roles that have introduced some of that just outside thinking of like, I know we've always done it this way, but why, right? And specifically in the context of technology. And frankly, I just feel like the like momentum is towards almost an expectation at a board level of what are we doing with our tech? Like, how are we upgrading our systems? It's easy to look at something like the Truist merger and the headlines around that, and how much they emphasize the technology component of what they were doing. And for another bank that's a peer to them, or looking at them and saying, wow, like if they're making that as much of an emphasis about what they're doing, like what are we doing, right? And you see the CEO asking his IT person that. So I absolutely see that, and I think this only enhances that need to where, again, you see very specific use cases like the PPP loan application program where it's failing like big time. And, we've talked to people all the time with experiences of them not getting their loans through, talked to banks all this week about certain ones that are having trouble getting their loans submitted because they're failing. You see some banks, not even all just big ones, that have built technology in a way that they can adapt quickly. And a lot of that has to do with some of the core systems. And they were able to build, the SBA announced that they would do a one-time batch file thing. I think it was on Monday. And I mean, there's probably like 20 banks that caught that in time to actually build something to submit it, right? There's another however many thousands of banks that they could not turn around tech that fast. And so they didn't even have that choice really. And so they're doing manual submissions. And again, I just think you're seeing more and more like in this moment use cases of how having accounted for this, investing in this tech, et cetera, actually positions you to better deal with whatever comes at you. And this is a horrible thing to come at you, but it just reemphasizes that need. Just real quick, Bruce, to hit the real-time payment piece of that. I don't know that I've seen a direct correlation between any of the events happening and real-time payments specifically. I think the theme of that I feel like is consistent, and actually is more on the legislature side, is a recognition of how hard it is to get dispersed money at scale, right? And that why can't the government disperse money to all Americans like in a very easy way that gets it to them quickly? Obviously, if RTP was more widespread, that would present a really easy way to do that for a lot of customers and get them the money, in minutes, not in weeks. But I don't think that fully addresses it, in that there's a huge unbanked population that also still becomes a gap there. And there, are other solutions we've seen for that, which I think are good. So I hadn't seen as much of a direct correlation to banks saying like, oh, wow, like we really need to have RTP in place. I view it as more of, there's almost like a societal or like a government kind of acknowledgement of like, why don't we have a way to disperse these funds quickly? Shouldn't we have that? And then you get into the digital dollar concepts and all these things that are a little more outside the box of what we've been building so far.
I'm a crypto hater, so don't push my buttons. You'll get a reaction. So I think the last point on the core payment infrastructure thing, it's super, super relevant that the IT spend, and that I think was the frame of the question too, the IT spend is dominated by people like FIS and Fiserv, both of whom are now in the merchant acquiring game, merchant processing game with the acquisitions of WorldPay and First Data, respectively. They, of course, have to see the overlap between those businesses and real-time payments. And just keep in mind, if you're a processor, you don't care. Interchange is not a thing. Interchange is irrelevant to you if you're a processor. So you're just looking for clicks. You're looking for more stuff. More different stuff is value added, that's differentiated. So I think if we look at where the big banks are, the top three in particular, and their investments in merchant-facing payments infrastructure independently, we look at the largest providers of IT services to the banking community and their acquisition of those kinds of platforms. This stuff's on a collision course. It's on a collision course that's moving at intergalactic scale and speed, meaning it's kind of slow, but it's sort of like, oh, this is gonna hurt. So I think there's some tumult that probably got accelerated by this, but it just can't move a whole lot faster than it already is. But I do think we'll start to see some use cases, outbound payments for sure, but I'm kind of banking on inbound payments, and it relates to our last question. Sorry, we won't have time for more, I don't think, which is, should interchange costs be looked at again right now, given that we're seeing an increase in digital payments acceptance? So this question, I'll just give the audience who may or may not be familiar, a couple of key points around this. First of all, cost of acquiring, cost of payments online, way higher than physically in a store, right? So that's the first piece that this person's asking a question and is highlighting. The second, which you may or may not be aware of, is your dear friends at Visa and MasterCard last year pushed through massive changes in interchange. They would say on the whole, it was balanced, meaning the aggregate levels of interchange are the same after the change as before, but there are absolutely winners and losers in that. And just to cut to the chase, this is an unqualified opinion that's going to be a rough generalization. The winners were kind of more physical participants in the payments ecosystem from a card's perspective. The losers were the digital. So digital paying more interchange going up as a percentage of cost of sale or volume, and physical retailers, like grocery stores, et cetera, they're seeing their costs go down. Some B2B going down as well, and blah, blah, blah. So effectively, ironically, that just was supposed to come into effect. Actually, I think it was April 1. So irony there. But it got delayed. It got delayed because I think they didn't want people rioting outside of Visa headquarters or MasterCard headquarters, respectively. Really just terrible timing. So yes, it's being looked at. It's being looked at probably, to the question asker's intent, the exact opposite of what you probably intended by your question or expected in terms of what's really going on under the covers. Does that mean it'll not only stop, but perhaps get re-adjudicated so that there isn't quite the same set of winners and losers? Maybe more people are digital. Maybe the ecosystem really needs to kind of embrace digital as the primary means by which we conduct payments as a go forward, as opposed to thinking of it again as sort of something to the side. I'm not sure, but Scott, I'll let you weigh in, and then we'll do our last poll and close out the webinar. Thank you very much.
Yeah, I'll keep it brief on this one, and that I think it does cause companies to look at their interchange cost and really just their cost of transaction, right? And probably both attempt to negotiate better rates for those digital transactions, as well as ensure that they've got blended rates and other things. I think from a card network perspective and bank interchange perspective, that's kind of more of the same old game of, I mean, it's in their best interest to continue to keep interchange at the highest levels they can. That's just capitalism. I think if as the pressure mounts around, is the cost of a digital transaction the same for a bank or a card network, then inevitably that gets pressure over time. But I don't think COVID or kind of the impacts of the sudden shift to digital like dramatically changes that scenario, or that I mean, that's a long running kind of negotiation, if you will. And I think that'll just continue to play out. I do think over time the cost of digital transactions will come down from an interchange perspective, but I don't know that it's in a sudden way or in a new way.
All right, Scott, I'll let you finish the last comment with how do you see the road from here? Are you in fact optimistic, not sure yet, or a little concerned about where we go from this point forward?
Yeah, I'm super optimistic, Bruce. Again, you always feel slightly guilty saying that, just given the things that are going on, and you want to acknowledge that. But I do think, I'm a big fan of disruption. I do think it takes disruption to break through barriers and to evolve into new things. I think there's enough disruption that's happening right now to all of our lives that I do feel optimistic that good will come out of this. So I'd be happy to be past it from just a world and a human standpoint, but I think it could have a positive impact on society overall.
Thanks again for your time. We'll look forward to chatting again soon. Thanks everybody for joining, and we'll look forward to catching up with you all as soon as all of this nonsense is behind us. Take care.
Thanks, Bruce.
Take care.